Welcome to this month's monthly market update with David Spika from Guidestone Financial Resources. David, good to have you again this month.
Hi, Jonathan. Great to be here.
All right, so let's get this out of the way early. We've talked about this a little bit in the past in some of our previous episodes, but I know you're a big college football guy, and I'm going to give you, like 15 seconds right here to gloat about A&M's big win this past weekend.
Giga Aggies beat Alabama. That was great. One of the best wins we've ever had, and fans rushed the field, and there was no super spreader event, so it was a great day.
Yes, I bet you really enjoyed that.
I did. Got to watch it with my son. We had a good time watching that. Yeah.
Yeah. Well, hey, let's jump into this this month. It's October, or as I'm going to call it on here, Stocktober.
Okay.
Since we're talking about so you're okay with that? Okay.
Oh yeah, I didn't work. Sure, why not?
Stocktober. It's the Stocktober monthly market update.
Yeah,
we've got one quarter left, basically. We're starting, I guess, the beginning of Q1 a lot for businesses. Is that correct?
Most businesses have a January 1st first quarter.
Okay.
They end the year on December.
All right, so we're going into the fourth quarter of the year.
Fourth quarter.
The biggest retail quarter of the year, typically.
Mm-hmm.
So what are we expecting from the stock market, from the markets this month? I know, historically, October's been kind of a tough month at times. So what are we looking at in 2021?
Well, historically, September is the worst month, and we did have a pretty rough September. Stocks were down about 5%. We finally got that elusive 5% correction that we hadn't seen in a year. But historically, again, markets generally can be a little bit ragged in October, but then they're followed by the Santa Claus rally in November and December. So this year will be interesting, though, because we've got headwinds and tailwinds. So in terms of tailwinds, we've got declining COVID cases. We got a little bit better valuations after the 5% drawdown. We still have low interest rates. And we've got better economic data starting to come out after a summertime lull. On the negative side, the headwinds would include the supply chain inflation issues that continue to plague economies around the world. We've got the Fed starting the tapering process later this year. We're likely going to have weaker earnings and economic growth next year. And so all of that combines to create a kind of a headwind for the markets. So at the end of the day, it's going to be a little bit of a push and pull. If I had to choose, I would expect there to be the traditional Santa Claus rally in November and December, but next year is likely going to be different. It's probably going to be a lot more volatile and a lot more difficult market when we go into 22.
Oh, wow. So speaking of the headwind that we've been facing basically for the last 18 to 20 months has been COVID-19. But, we got some good news this week. The Merck experimental drug, it's a pill form to help with the effects of COVID-19. That is possibly coming to market soon. So we have approved vaccines, we got boosters, we have now some therapeutic medicine that is coming out. Is that kind of like the light at the end of the tunnel, maybe, that we're getting past this? Is it too early for us to get our hopes up yet that we may be about to get beyond the pandemic?
I don't think it's too early, John. I think this is all great news. When you combine the vaccines with the fact that we've probably got about 90% immunity in this country, 90% or more of adults have some form of immunity, with now a treatment that if you do contract the virus, there's a treatment that can help you overcome it. That's all great, great news. I've always said I didn't think we could eradicate this virus. I always thought that was short-sighted to believe we could get rid of it. We just have to learn to manage it. And with the advent of these medications, we are learning how to manage it. So between immunity and medications, we're getting there. And I would also say it's really encouraging to see people living lives again, to see people traveling, going to football games, going to concerts and weddings and getting on airplanes without a big uptick in cases. I said earlier, we've seen case counts decline, and that's a great sign. And so all of this gives me a lot of hope and should really be a positive for consumer sentiment.
Absolutely. And I'm in fact headed to a concert tonight here in Nashville. So
good.
Looking forward to that. And it does feel like things are kind of getting back to normal, and that is a good thing. But one of the things that I noticed, and I know you've probably noticed, and many of those watching, is supply chain disruptions, whether it be, car parts, whether it be lumber. I know there was a big lumber shortage or something back in the summer where the price of lumber skyrocketed and everything. We got shipping delays, other issues. We got the busiest shopping season of the year right in front of us. You called it the Santa Claus rally. What are we looking at with the supply chain disruption, and how might that affect the Christmas shopping season?
This supply chain issue is probably the biggest risk we face today, Jonathan. It's creating inflation. It's creating uncertainty around whether or not people can get the goods and services they need. And it's a real issue for us today. What's causing it? Well, there's a number of things that are causing it. It starts with the labor shortage. We've got labor shortages all over the world. We just had the September labor report here in the US. It was disappointing. The economy only added 193,000 jobs. We thought we were going to add 500,000 jobs. The unemployment rate went down to 4.8%, but that's because people are dropping out of the workforce. I don't know how they're supporting themselves, but they are. And this is not just a US phenomenon. This is global. So you add that to the fact that COVID is still causing problems around the world. You have ports shut down in China, for instance, because of COVID. And you also have companies rebuilding their inventories. So this just-in-time inventory process where companies run very lean on inventories, well, they shut all that down during COVID. They're having to build those inventories back up. That's exacerbating the problem. You've got ships waiting for 3 weeks to be unloaded, tanker ships to be unloaded in Long Beach and LA. I mean, it's a real concern. And it's something that we're keeping an eye on. Again, it's one of those vagaries of shutting down the economy globally that we just didn't expect because we've never done it before. And we really don't know what the solution is. We're hopeful we'll work through it. Honestly, we thought we'd have worked through it by now, and it's going to take some time, but this could be a difficult Christmas season. Retailers do the vast majority of their revenue in the fourth quarter because of the Christmas season. And if they're not able to get the goods that they need to sell to consumers, it's going to really hurt their earnings, and that'll have an impact on stock prices.
Yeah, is this maybe the biggest surprise that's come out of the pandemic? Is the global workforce kind of shut down that we've seen?
I mean,
obviously, I think none of us expected the stock market to rebound as quickly as it did, but that obviously was a big surprise. But just the lingering effects of the global workforce shutdown just seem to, they don't seem to be going anywhere, and nobody seems to be able to explain why or how to get out of it.
The fact that we can't get people back to work, there are 4 million more jobs available in the US today than there are workers willing to work them. It's nuts. And part of that is a skill set mismatch. I mean, maybe those are blue collar jobs or service sector jobs, and it's white collar workers who aren't working. I don't know, but there's a lot of factors. It's COVID, it's childcare, et cetera, et cetera. I've seen all kinds of reasons for it. But yeah, that is by far the biggest surprise and something that we've got to get past, because without labor, we can't create goods and services to drive the economy. And that's
automation can only do so much. I mean, we have seen a growth in automation over the past decade or two. But at the same time, at some point, you've got to have bodies. And
somebody's got to program that robot, Jonathan. That robot's not going to program itself.
It don't program itself. And if it does, then we're all in trouble, right?
We're in trouble. We're going to need Will Smith to come save us.
Oh boy. Oh boy. Man. So also, something I've watched, and I think we've talked about it over the last few months, is the increase in oil and gas prices.
Yeah.
Those continue to increase. So, this is never seems like a good thing on the economy when we see oil and gas prices skyrocketing. What's the potential impact here as we enter the winter? And now you need like heating oil in the northern part of the country, and different iterations. We haven't needed fossil fuels for the last few months.
This is purely a supply-demand imbalance. It's pure economics. You learn this as one of the first things you learn in an economics class. When the pandemic hit and economies shut down, global production of oil and natural gas shut down. All right. Now that the economies are rebounding, demand is taken off, and there's not enough supply to meet demand because production was curtailed so sharply. Add on top of that a global trend away from fossil fuels and to green energy, and you've got a real issue with the amount of oil and natural gas available to meet demand across the globe. Other factors that are contributing to it is in the US, there's an expectation we're going to have a colder winter this year than normal. So natural gas prices, which do a lot of the heating around the country, have already risen to reflect that. And in Europe, 20% of their power production comes from wind farms, and they've had less wind this year than normal. Go figure. So those are other things that are creating this imbalance. To date, this year, petroleum prices are up 70%. Natural gas prices are up 120%. They haven't been this high since 2008. And so it is a real issue. It'll affect consumers. It'll affect consumers needing to heat their homes. It'll affect consumers as they start commuting back to work. All of these are going to be a tax on the consumer. The good news is that this will result in significant increases in capital expenditure and investment by energy companies, because they've got to get production back up to levels to meet the demand. And so that increased capital expenditure will flow through the economy and have a positive impact on the economy. Net, it's probably a negative near term. Longer term, that increased capital expenditure and increased production will create a ceiling on prices, and we'll be able to get back to a more normalized level. But yeah, near term, it's a concern.
Well, speaking of concerns, politics and the role that it plays on the markets, we've got a debate over the debt limit expiring. We've got the need or not need for more stimulus, depending on who you ask. You just mentioned, the unemployment benefits running out and things like that. Also, the likelihood of higher taxes. So whenever you start looking at investors, and what is your counsel to them as far as investing and how politics may be, playing a factor in the economy in the next, 6 to 8, 9 months?
The political environment is something that we've cited all year as a potential risk. And if you think about it, Jonathan, when you have one party control of both houses of Congress and the White House, plus a president who believes he has a mandate to make big changes, you've got the potential for a lot of upheaval. So you mentioned the debt ceiling issue. Well, that can has been kicked down the road. A temporary solution was put in place, but it's going to have to be readdressed by December 3rd. So it hasn't gone away, and we could have more volatility around that. On the stimulus issue, the progressive wing of the Democratic Party wants another $3.5 trillion in what they call social infrastructure, but there are 2 moderate senators who are pushing back against that. So that debate's been going on, and today it looks like we'll end up with probably another $2 trillion in stimulus. This is going to put us close to $10 trillion in government spending to get us through COVID. Is that necessary? Seems a little excessive. Bottom line, we're going to have higher taxes. We're running huge deficits today. The debt limit debt has gone way up, and those higher taxes are going to have a negative impact on the economy. There's just no way around it. And that's growth next year will be impacted. Growth over the next several years will be impacted by those higher taxes. Now, as investors, particularly long-term investors, you don't need to worry about this. It's good to know about it and be prepared for the volatility in the market, but stay invested, particularly if you own the target date funds, the My Destination funds. Just stay invested, because you've got a long-term time horizon, and these near-term things should not affect your ability to generate good long-term returns.
Now, you mentioned the $10 billion that the United States has passed,
Trillion.
I'm sorry, trillion with a T,
Yeah.
trillion with a T. You mentioned that. What's the global total? Any idea, any ballpark on that? Obviously, we're probably one of the leaders in that, I would guess, of how much stimulus we've passed. But any idea on the ballpark of the global total?
At one point during 2020, if you combine the impact of central bank policy and federal government policy, it was already at $30 trillion. So I don't know what it is today.
Wow.
The numbers are mind-numbing. Yes, it's global, and it's an issue for the entire globe. Yeah.
Wow. So, potentially up to like 50 trillion or something like that.
Easily.
Okay. Mm-hmm. All right. Wow. That's something else. All right. So you mentioned central banks. So the Federal Reserve actions and those of the central banks have been, doing a lot. You mentioned that interest rates are staying low, but what kind of impact do we expect from central banks on the market in the near term?
Great question. And the thing to remember is that the policies put in place by the Federal Reserve and other global central banks were probably the key factor in getting us out of the economic malaise of the shutdown and bringing the markets out of that. I mean, it was a huge, huge factor. And you've seen, and we've talked about this a lot, you've seen asset prices across the board go up as a result of the Fed lowering interest rates to zero and initiating quantitative easing, which is basically going out and buying bonds in the market. Well, now they're seeing inflation rising. So when they start to see inflation rise, remember, one of their mandates is price stability, which means inflation that's not too high or too low. It's too high today. They have to start pulling back on the stimulus. So the first step is reducing the amount of bonds they are buying in the open market. This is referred to as tapering. The Fed has said this will begin probably in November of this year. They'll start tapering, meaning they'll start buying fewer bonds every month until the middle of next year when they'll stop buying bonds. Interestingly, the European Central Bank is doing the same thing at the same time. So today, between the two central banks, they're buying $235 billion a month of bonds. That means $235 billion of capital is flowing into markets and flowing across the globe and having an impact on financial markets. Well, within the next 12 months, that goes away. It's zero. What impact does that have on markets? It's going to have some impact. Our market's going to crash, probably not, but it's going to have some impact when you had $235 billion a month propping up markets that no longer exist. Down the road, the next step would be for the Fed to begin raising the Fed funds rate. Now, they started doing that going back to the financial crisis. They went to zero at the end of 2008. They started raising rates again in 2015. So for 7 years, the Fed funds rate stayed at zero, where it is today. They started raising rates. If you remember in 2018, they got up to, gosh, what did we get to? 1.5%, maybe 1.75%. The market did not like it. We had that big downturn in the fourth quarter of 2008 when the Fed raised rates in December. Then they started pausing, then they started lowering rates again. So the market does not like increasing rates. The market has become very much addicted to low interest rates. And I'm concerned that the Fed is going to be unable to normalize interest rates at any point in the near future because the market just won't allow it. So it's one of those things, again, it's a vagary of COVID, but really it started back in 2008 that the markets have become accustomed to. There are people in this industry, Jonathan, who don't know what a stock market without significant Fed stimulus looks like. They just don't understand because they've never seen it. And that's a concern. So one of those things, again, individual investors don't need to get too worried about. Stay invested, but it is something that professional money managers are keeping an eye on, and we are factoring into our decision process.
All right, so final question here today, and we're going to wrap it up. Where should long-term investors put their money today, and what should they expect over maybe the next 5 to 10 years?
Yeah, I think the expectation should be for more muted returns. We've had very, very strong returns the last 3, 4, 5 years. Going into 2022, we're going to have slower economic growth, higher taxes, lesser Fed stimulus, certainly lesser government stimulus. All of that will create a much weaker backdrop for markets. As I've said many times, investors who own the My Destination funds, stay invested. You've got a 20, 30, 40-year time horizon. Just focus on that and don't overreact. If you don't own the My Destination funds, own individual securities or individual funds, non-dollar denominated asset classes look attractive today. So emerging market debt and equities, real estate investment trusts look attractive, but you're going to face more volatility. It's just a matter of fact. We've got a theory called reversion to the mean. We've gone way above the mean. We're going to have to come back down to it. And it's just how markets work. Long-term investors, though, stay invested, keep focused on the prize, which is the long term, and you'll be fine.
All right. Well, thank you again for joining us this month, David. We really appreciate you coming on each and every month here on the Baptist Press Facebook page for our monthly market update, and this month to celebrate Stocktober. So again, congrats to your Aggies. And folks, thanks for sticking with us here on the Baptist Press Facebook page and coming in every month just to kind of hear about what's going on. We appreciate David and all that he has to offer. Again, guidestone.org for all the information that kind of he's talked about here today, and to find out more about how Guidestone can help you as well. So thank you, David, and thank you for watching. We'll see you next month.